We are under 24 hours away from the next FOMC decision. As it's widely expected, the Federal Reserve will raise interest rates to the highest level in 22 years. For more on what this means for markets moving forward, we want to welcome in Blake Gwinn, RBC Capital Markets Head of Rate Strategy, as well as Jeremy Schwartz, Wisdom Tree Global Chief Investment Officer. Blake, let's start with you here in studio. As we think about where things are likely to move beyond the meeting tomorrow, the expectation is another 25 basis point hike. Will there be a second one down the line? What are you looking for?
Yeah, that's a big question. I think tomorrow, I wish I had a big juicy headline for you guys, but I think it's going to be relatively quiet. We all know the 25 basis point hike is coming. Also keep in mind at this meeting, we're not getting an update to those SEP dot plots, as we call them. They give us some idea about what they're expecting down the road. The last version we got in June did suggest that they were going to hike again, but so far markets have not really bought on to that idea yet. If you look at trading in the Fed funds futures contracts, it's still suggesting that markets don't really see that September, November additional hike happening. So I think people are going to be really keyed in tomorrow to Powell's press conference, just listening to see if he gives any kind of signaling one way or the other. Personally, I think it's a little bit too early for that. We still have 2 NFP prints, 2 CPI prints before September. So I just don't really see a reason for him to start pushing markets one way or the other, or to start closing down their option set as they move into that September meeting. There's a lot of data and a lot of time to make that decision on what to do after the July meeting.
Jeremy, what about you? Is tomorrow business as expected? And if so, how can investors best position themselves to anticipate the Fed and what their tenor may be in signaling the future?
Yeah, I agree. Tomorrow's not a major story, not a lot of major surprises. We do think the Fed's making a mistake in a sense. We think they don't need to keep hiking, that inflation is on its way down. Now, we've been surprised actually how resilient all the markets have been, the labor market, the housing market. We got another Case-Shiller housing data point this today, 4 months in a row of increases after 7 months of declines. That's been one of the feeders into our view that inflation's already coming down, was for the downward trajectory in shelter inflation. But, hopefully they don't keep going too much. I mean, the higher they go, the more risk they do put us into a deeper recession than necessary. But we got to admit that the market and the economy has been resilient to all these higher hikes.
Let's talk about sort of the macro conditions that are driving all this, Blake. We got the IMF today upping their growth forecast. We're talking about 3% for 2023, now 2024, 3% as well. As you look at the economic data, I know you said that you think it's too soon for the Fed, given what we know right now, but are we starting to see the real possibility of a potential soft landing? In other words, are we starting to see sort of inflation pull back at a pace that maybe the Fed is a little more comfortable with?
Yeah, absolutely. I think the soft landing is quickly becoming somewhat of a consensus in the markets, which is pretty shocking when, compared to where we were 2-3 months ago post SVB. People were very, very, cynical on where the U.S. economy was going, and I think people were pricing in cuts as soon as the summer. That has clearly not turned out to be the case. Jeremy mentioned a lot of the positive data. I think if you're looking at the Fed and kind of thinking where they are relative to June, I think some people might be expecting them to soften their tone because the inflation data did come in a bit weaker. But if you look at the totality of the data and what's been happening on jobs, what's been happening on consumption, it does look like this soft landing narrative is coming to play. It was often derided as immaculate deflation, but that's what we're seeing. Inflation's coming down at a pretty healthy rate still. And meanwhile, we haven't seen that pain on the labor market or growth data that I think a lot of people thought had to go hand in hand necessarily with that slower inflation.
So that means, Jeremy, possibly a end to this airline analogy that we've been using for the better part of about a year at this point. So we'll have to find something new. But at the same time, it brings in this larger question of, okay, so if soft landing, then rally on. And if so, where should investors be positioning their portfolio?
We had been getting more cautious. We're starting to upgrade our view of the economy, actually, and that would actually lead you to some rotation away from what's been working right now. What's been working has been growth in all the AI stories. If you view that the economy is not going to go into recession, you could go to the more cyclical areas like small cap, value, which are pricing in a recession in our view. If you avoid the recession or even have a softer recession than people thought before, this could be a return to sort of the cheaper price segments of the market. And that's one of the things we're looking at for the latter half of the year.
And Jeremy, as we look ahead to after hours earnings today. We were talking about some of the big tech names that we're watching that have largely seen their valuations balloon on the back of this excitement around AI. I mean, where are you positioning yourself on that front? What does the tech thesis look like?
The higher the multiple, the higher the expectations, and the easier it becomes to disappoint a little bit. We're writing a piece right now on NVIDIA that is 40 times trailing sales, 25 times forward sales. If you take those optimistic estimates of where they came, the probability that they can outperform from 25 times sales is not great over 3 to 5 years. Less than 10% of companies that got to that multiple went on to outperform over 3 years. In the short run, perhaps the momentum continues. But if you're saying the next 3 years, I think it becomes much harder. But generally, all the big tech, they're selling at 30 times earnings. The rest of the market's much cheaper. To me, I'd prefer things like 12 PE, high dividend stocks than the 30 PE tech stocks at the moment.
Stay with us, guys, here, because one thing that we also have to talk about is something that came out this morning in terms of economic data, the Conference Board's Consumer Confidence Index for July. That hit a reading of 117. This is the highest level in 2 years as consumers are feeling increasingly confident about the current state of the U.S. economy. Blake, do you expect this trend to continue?
Look, I do think consumers are going to start slowing down. One piece of that data that I think was a little bit overlooked was the percentage of consumers who said that they were planning on cutting back, in the future. And that is actually still showing a meaningful number of people who are planning to cut back. You kind of couple that with the idea that student loan repayments are going to start, which is going to bite into people's ability to spend their kind of monthly budgets. I think both of those things combine to start pulling back consumption into the end of this year. And we do have a little bit slower growth in Q3 and Q4, but still very far from what I would call a recession or a capital R hard landing type of recession. It's just very slow growth, and then in 2024 actually comes back into positive territory. But that is driven in part by this slowdown in consumption that we're expecting later this year. Yeah,
are we starting to see maybe more of sort of that divide narrow? We've been talking so much about the consumer confidence versus the actual spending that we're seeing. The divide that exists there, maybe that's starting to kind of narrow here as sort of consumers look at pulling back further and seeing the reality.
It is, and I think over this last year and over this cycle, I think a lot of people have rightfully become a little bit more leery of this kind of survey data that a lot of times doesn't really seem to match what consumers are actually doing. And you could say the same for businesses as well. So yes, those things are perhaps coming together, but we do think going forward that is going to start to slow.
Jeremy, how does this show up in terms of some of the companies that we're going to be watching who are reporting earnings today? And they've got 3 months worth of data plus some of the current quarter to look at to get a real-time pulse check of the consumer, whether that be in their purchasing patterns on their e-commerce sides of their website, whether that be in how much they're engaging even in social platforms with brands with purchase intent. So where can we really look through some of the data that comes out today during earnings to signal or give us some type of sense of the pulse check of the consumer as well?
I mean, what I hear on these tech companies is increased spend. They're spending to make these AI investments. The question will be what the revenue comes in the future. NVIDIA, the semis, they're the direct play for what are people buying? They're buying these AI chips so they can do all this stuff. Hopefully adding new business opportunities for these tech companies. It's too early, though, to see it fully come to play. And so that's where I feel like in expectations might be a little high at the moment. But we'll have to see how it shows up. I mean, you're going to need to see revenue to match all the spending that's expected for AI. And I think it's just early in that transition.
All right, Blake Gwinn, RBC Capital Markets, Head of Rate Strategy, as well as Jeremy Schwartz, who is the Wisdom Tree Global Chief Investment Officer. Thank you both for the time here this afternoon. Really appreciate it.